Good afternoon. Happy Saturday, everybody. Welcome back to the weekly market analysis for the week ending November 25th. We are coming at you a day after the close of the markets for the week. And this week was a little bit different because of the Thanksgiving holiday in the United States. Honestly, didn't really pay a whole lot of attention today to the markets, or this week, I should say, to the markets. So a lot of this analysis that is coming this weekend is in real time, and what we want to do is we want to get in touch with what's been going on in the markets this week, look at the overall trends, think about what is coming over the next few weeks, and look ahead into December. As by the time we do next week's video, we will be into December. It'll be the last month of 2022, the last month of the fourth quarter, and there's a lot that's been happening across 2022. If we just turn on the year-to-date version of this chart, you just really can see it's been basically down all year with a couple of bounces. We're in the middle of our third real bounce, and a lot of people wondering if the bottom is in, if these October lows mark the bottom, and or whether this is just a bounce that is going to be faded. And a lot of questions that we hope will be answered in the near future, either this month, in December at the Fed meeting, maybe charting a course for lower rate hikes and then eventually a pause. And will that pause come in the first quarter of 2023? A lot of questions regarding the economy, what's happening in the economy right now, what will be happening in the economy. And so as we head into the last month of the year in 2022, it's important to make sure, once again, that you are aware of what's going on, that you, if you're going to be trading over the next couple of weeks, that you're setting your levels accordingly, that you are managing your risk properly, and putting yourself in a position to start 2023 on the right foot. And so that's what I'm trying to do in this last month, is trying to get my bearings straight for the new year that is ahead. So taking a look here at the markets, as we zoom in here on the S&P 500, as you can see, price on just a couple of days this week on pretty low volume. We got a pretty big day on Tuesday, followed up by a decent day on Wednesday. Not having not made a higher high on a wick basis than our bounce on November 15th last week. And as you can see, we are getting right up next to the 200-day moving average. That's the red line right here. And we are also coming to trend line resistance, which is has been basically holding true from the January high at the beginning of the year to the March 30th, March 29th, March 30th bounce. We almost came right up to that on the bounce that finished in August, and that we'll see over the next week or so if that level holds true. And so I guess from this standpoint, this is a risky spot to be taking any new longs. So if you are long, depends on, I guess, where you went long, if you've been long on this bounce. But if you have not taken any new long positions, this is actually a place where if you have the bias that the market is going to head back to the downside, this is a good spot to manage your risk around, and just show you some levels here that I would be watching. I would be watching the 200-day moving average here. So if you watch the price action on Sunday night and into Monday, if we get a down day, and if we take out this daily candle from Wednesday, then what that might be, it might be a good idea to take a trade to the downside with a stop loss just above the 200-day moving average, because obviously these levels, as you can see from back in August, if you look at the left side where I just drew that circle. Um, Price does, in fact, often bounce above those moving averages, or even just normal resistance or support levels. Price can wick through them and then still close on the underside of them, like in this case on a wicking above and then still closing on the underside. So you don't want to get too tight on those. Just placing the stop slightly above would be a wise place to go. I don't think that it's, you shouldn't on Sunday when futures open, if you're trading futures, or if you're just trading SPY ETF, you don't want to just jump right into the trading session and just immediately take the short position or buy the put or whatever. You want to kind of watch what happens with price. Like I said, if price does engulf down past this Wednesday candle, if we have a significant enough down day, then that would be this place where you take the opportunity with pretty good risk to reward. And then what you would do otherwise is if price comes up, then you're going to watch the descending trend line resistance, and the same kind of thing you would want to watch for. You'd want to watch for price to come up and hit and then bounce off of it. And then once you get that bounce off, you place that stop loss right above the trend line resistance. And then you've got, once again, good risk to reward there. Again, those are the most probable trades that you could make, at least on the S&P. And then obviously you have to be aware of the downside. We have support at 39.16. We also have the 100-day moving average, which provided support on the wick down on Thursday, the 17th of this month. You'll have the 50-day moving average, which is going to be curling up at a much higher or much quicker rate than the 100-day moving average will. So you want to be aware of those as they are psychological support levels, just as much as the 200-day is right now a psychological resistance level. So you want to be aware of that. When you go into the NASDAQ, we're in an interesting position between the 150-day moving average, also sitting on pretty light support, was resistance, now is some light support around 11,771. And so kind of a similar position here. I would actually give this a little bit more room because the NASDAQ has underperformed versus a lot of the other indices over the last couple of weeks. And so you want to be aware that price may actually come up and test what is becoming a confluence between the 200-day moving average and the descending trend line resistance. That area, I'm going to be watching that spot. If we continue this bounce at least for another week or two, I'm going to be watching that area as the place to potentially take a downside position. And again, just so we're clear, my bias is actually to the downside. I think we actually will get another some more to the downside before the end of the year. What's interesting here is on the Dow, when you look at the Dow, which is only 30 stocks, and they tend to be more cyclicals, even though there are some other types of plays in there. What's interesting is the Dow took out its August high, again on low volume, so I don't know that this is anything to really get excited about, although this is to my point earlier when I was looking at the S&P and on the NASDAQ, saying you need to be careful not to just jump into a downside position, because price could actually trade up early in the week, and I would bet that would happen because I think people are going to see this this higher high as something to buy into. People are going to be convinced here that the Dow is the sign that the markets have in fact bottomed, and you could see that the 50 and 100-day moving averages are curled up pretty significantly, and the 200-day moving average is leveling off. Price well above that, well above its previous trend line resistance level, and so we'll just get rid of that. And so, but I mean, prices come up really hard, pretty fast. If we go from just the closing bottom, we are up almost 20% from the Dow. If we go from the wick lows, then we are 20% up. So we do want to be aware of the potential upside momentum There's a lot of discussion about seasonality, Christmas rally. I just saw recently some discussion about the DXY having a more negative bias into the end of the year seasonally. So those that all of that would be fuel for the rally continuing. We'll talk about the DXY in a minute. The Russell has had some trouble getting above its trend line resistance, and let's see here. Yeah, which you might recall on this channel, I debated with myself about whether or not I was going to move this trend line from where it originally was, because we never officially made a lower low back in September and October. And yet you actually can see here that this resistance is actually holding pretty well. We've wicked above it a bunch of times and haven't closed above it. We touched it again on Friday's shortened trading day. And we are squeezed right below it and above the 200-day moving average. So if we get the a breakout here again, that kind of goes to what I was saying on the S&P and Nasdaq. You have to be aware that the Dow or the Russell, if the Russell broke out or if the Dow follows through to the upside, there will be some considerable risk-taking momentum across the spectrum of the indices. So I think that's something to be aware of. But yeah, so again, be careful on if you have a downside bias, if you don't think the bottom is in, or if you at least think that we're going to get another move to the downside before bottoming, or before resuming up, then you want to be careful chasing the momentum to the upside. Again, managing your risk around levels, even here on the Russell, probably the best place to manage your risk is right above the green wick. So that's about 1920. Again, watching price action. If you want to get really, really aggressive, then if we resume to the downside, then you could put it just above the resistance level. But the safer bet is above this wick from November 15th. So want to be aware of that. Going to the DXY, I'm leaving the moving averages because we actually did come down once again. We bounced off of this level that I put down, and of course I took my victory lap last week a little too quickly because price has now come down again to that level. Holding so far, and that's also where the 200-day moving average is coming in. I did say it would not surprise me at all to see price come along the 200-day like this before coming up to this level. So I will say, I will remind all of my viewers of that. But definitely it hasn't behaved as I hoped it would. And so I'm once again, like a lot of people, rightly so, have been calling at least near-term top in this area. Of course, I was holding judgment because I had been in winning dollar trades since back here where this green arrow still is. And then just taking little nibbles here and there, which is fine when you're over 80% up on the year in your FX trading. And so this is going to be a really crucial spot. If we fall below the 200-day moving average, the last time that we made a significant drop below the 200-day moving average back in May of 2020, obviously you see how the dollar went for the rest of that year. So it's going to be a big deal. I do, like I said, expect there to be some support on the 200-day moving average. I do expect a bounce somewhere close to 112. And then I could totally see the dollar coming back down from there. So we will see. A lot can happen over the next month. It would totally line up within my timetable to see the dollar come sideways for another week or two, get a good bounce into the end of December, and then start coming off in late December, early January. So that's kind of my expectation. But obviously, if you are interested in taking long dollar positions, then very similar to how I was describing, it's very similar to how I was describing the downside trades on equities. If you watch the dollar move back up here, then a spot to take a nibble would be and have a stop loss. If you're buying the dollar in the ways that you can buy the dollar, you could take that there. Otherwise, you'd have to check on the various currencies crosses like the euro, the pound, the yen, and so on if you're thinking about taking positions there. On the 10-year Treasury yield, again coming sideways. We still haven't made. I put this yellow line here. We still haven't made a lower low. We have come down close to it. Um, so we are below the 50-day moving average. We'll see what happens there. Still above the 100 and the 200-day moving averages. Momentum still very clearly to the upside. Um, Still have a lot of room that we can come back on the 10-year Treasury yield, and still be able to move up and make higher highs. A lot of this will depend on the rate decision that happens in December, so still have a couple of weeks. Another thing I do want to point out, both for the DXY and the Treasury yields, and then obviously those will have an impact on the equity indices, is that we are getting a data release next week on, I believe, Thursday or Friday. It's the core PCE data. A lot of people expecting that it's going to come in below expectation because the core inflation in the core CPI was lower than expectation, misses across the board, and core PPI was below expectations. So a lot of people expecting that core PCE will come in low, below expectation. So that'll be something to watch for. I won't make any predictions about that here, other than to say I don't. Well, I guess I will make a prediction. I don't believe that the core PCE will come in as low as people expect. And I actually think, and I've done some research and some analysis on this, and you could look at on my Twitter account if you're interested in my newsletters. We basically have to see the month over month core PCE below zero, basically negative, in order for the 3 month annualized core PCE to continue on a downtrend. And I just don't see that being very likely. So, in all likelihood, the 3 month annualized core PCE is going to be level or higher. And so I think that that's something we need to be aware of. That could be something that will affect the Fed, as well as the fact that the Fed meeting starts on the day that the November CPI is released on December 13th. So it's going to be something to watch. So the macro catalysts that could send yields and the dollar back up and equities back down are all coming over the next couple of weeks. But until they come out, that's why going into the first 3 or 4 days of next week, I could totally see this continuing to come off, the DXY either coming off or going sideways, and equities continuing their bounce. So that is something to watch out for. Taking a look at gold, we did get a little bit of a break. A lot of people buying this dip right here, thinking gold is heading back to the upside. Entirely possible, but this has come up so far so fast that it wouldn't surprise me to see price come back down again. And I've gone on record to say I think gold will get back down below 1700 at least one more time. So time will tell on that. But again, a lot of the markets are in places where the momentum has come up so hard, you don't want to buy the momentum. If you missed this opportunity to take a long position, this would have been a good risk to reward long position right here. And it could end up getting stopped out. But again, if you missed it, then there's no reason to chase it right now. You got to let things cool off, and you just kind of got to sit on your hands or sit on your thumbs, as they say. Crude oil did make a lower wick low, but yet has not made a lower closing low, almost right there. So if you're an oil bull, you're hoping this is a double bottom and that it's going to move back to the upside. Obviously, China continuing to show that they're not reopening anytime soon. What'll be interesting is over the next 2 weeks to see what happens with the oil price cap for Russian oil, if that's going to be if that's going to be a thing, or if that's going to be a non-event. If the Russians will, if they'll respond in any particular way, what's going to happen with OPEC plus, and so on, and then as well as the SPR. And a lot of people, I still think that a lot of people are selling the oil because they are convinced that recession is coming soon. They think that, and it could be happening a lot sooner than people think. And obviously there are people who think we've already been in recession. and that we've already priced past the recession, at least in equities. So, so that'll be interesting to watch. But again, downside momentum. You don't want to chase this to the downside. There is still plenty of room down to go. My target would be around 65 or so if we did continue down as the next logical place of support. But you don't want to chase it because you've already missed the move. In fact, this is a much better place to take long positions, prospective long positions, if you are interested in taking the upside with good risk to reward. So that risk to reward is right here below this wick. If we get price action to the upside, then taking the taking the trade to the long side with the stop loss around 74.50 ish would be a good wise place to do that for good risk to reward. And then finally on Bitcoin, again, getting our bearings here. Bitcoin is fluttering sideways. A lot of people got really excited earlier this week on some of the significant moves, but we basically have gotten back to the midpoint of where price traded into this really, really tight triangle. And so I think what worries me is we broke down and now we're bouncing, and then it looks like it wants to roll over again. So um, I don't have it up on Twitter right now. I don't have my Twitter, that specific tweet up, but I do want to say I do think Bitcoin is going to bottom in the next 30 days. Well, I put in the tweet, I put about 30 to 60 days, but I think it's more likely that we're going to bottom here in the next 30 days. And that coincides with my view that I think we are going to get downside in December. I think everyone's positioning for upside, and I think that it's going to go down. And I think Bitcoin's going to go down with it. And just to get everybody caught up on, I've been posting about this more recently, but right now the MRT shows the orange line coming in at 12,550, and in every bear market the price has at least touched and wicked through the orange line, and although we got close, if we zoom in here, although we got close, we didn't quite get there back in June. So and obviously we have made a lower low compared to what everybody thought. Everybody thought the lows came in June. So it's entirely possible that this thing rolls down and touches the orange line sometime in the next 30 days. And once it touches the orange line, that's going to be the opportunity, the generational opportunity, I think, to buy at a really good low price. So just thought I'd share that with you guys. Normally I reserve that for people who are subscribers to my newsletter. So if you are interested in subscribing to my newsletter, you could catch it right there in my Twitter feed. You could follow me at Mr. J. Thomason. Don't forget to hit the like button and subscribe to the channel here. And once again, thank you for tuning in, and thank you for being with me as we catch up on the markets this week. And I'll see you guys next week.